Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you gotta get spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, oh my gosh. Too loud, too loud. We got a Federal Reserve meeting this morning. Not this morning, this afternoon. But today is the Federal Reserve Day. And that's kind of a big deal. So we're going to see sometimes the markets will be super, super quiet the day of. Sometimes they will just kind of like mysteriously know what's going to happen and start moving. There is a little bit of movement on the DOM there. There's a little bit of trend coming up here. The S&P 500 is just getting creamed right now. Let's come to the charts, kind of give you guys a better view here. Where are you? Where's my... Here we go. Okay, so we are a little bit higher than we were yesterday in the 10-year treasuries. S&P 500 recovered for the most part yesterday, but we are starting to see a sell-off in the early hours this morning. I think that what you're getting probably is due to something in a specific stock. So we should go and try and check out what's going on there. Oil continues its slow and steady downtrend, giving up all of the gains that it had at the beginning of the month. Gold and silver, about where they were. Silver's still kind of struggling. Copper, looking a lot like oil. Japanese yen. Okay, so we got a good uptrend right there in the yen. I'm kind of liking that. And a Bitcoin. Well, Bitcoin is still above 1,000, or 100,000 rather, but not as much action as there has been a little bit, I'd say. A good uptrend there, though. Might find some support here. Yeah, I don't know. Probably trend lines like that, I don't find to be too effective. I did, yesterday I read, actually I still have it up. I need to read it. It was about the currency market. There are marked differences between the clustering patterns of stop loss and take profit orders and between the patterns of stop loss buy and stop loss sell orders. The differences explain. Yeah, so and what the way that I got to this thing, oh, I didn't switch the screen over. The way that I got to this was that these guys, they have like a way to look at resting orders on Onada. And they can find that, like, when it's a round number, that there will be take profits before the number and stops after the number. So, kind of suggesting that there is something to, like, the support and resistance idea. But I don't think that necessarily says that support and resistance is, like, a good strategy. But rather kind of explains why you get messiness around some of those prices. So we might be able to utilize some of that to our advantage. Like, I think the way that I would want to use it is, like, if I know that that's a big number, like at 16, I want to, like, buy it before the 16 and sell it after the 16 on, well, actually not buy it before. Like, the thing is that it will be hard for it to get there because there'd be people take profits before it. But then if it gets through it, then you kind of get the stops, right? So there might be some ways to gain that out. Or in the S&P 500, like, maybe if I'm going to buy, it makes more sense to buy like 50. Because if it's 25, then you're probably going to get pinned at the 82. But if it's 50, you get a better chance of it going up to the 83 or maybe 75 or 50, right? And the other way around if you're going to sell. And that might help you a little bit. Maybe we can test some of that. Why did I even bring that up? I don't know. It was just down there. Okay, Vital asks, could you explain the terms behind note auctions and their significance in the price? Bid to cover ratio, high yield, pre-sale, WI, award percentage of bids at high percentage of distribution. Okay, so let me explain how the bond auction works generally. So, wait, let me blow my nose. Okay, so what happens is the Treasury announces an auction, and if you're like a regular person, you can go and you can put in what they call a non-competitive bid. So you can say, I want to buy a Treasury this auction. I want one of those Treasuries. So you just put in your order essentially, okay? And it's like a non-competitive bid, which means that you don't get to say anything about what the price is going to be, okay? So then what happens is the auction happens. They start the auction at, the price that the treasuries are pricing at that time. And then they look at all of the non-competitive bids and they say, okay, so like if they're going to sell $1 billion worth of, I forget what the numbers tend to be. I think it's in the tens of millions, but let's just say that it's $1 billion. Let's just say that let's say it's 100 million, okay? And maybe there is like 25-30% of that is non-competitive bids, okay? So retail and other people trying to buy it, right? Then you got the dealers. So these are people that are specifically licensed to be bond dealers. And their job is essentially to buy the rest of it. Okay? So that's, 75% of it or whatever the deal is has to be bought by the dealers. I think it's actually a smaller percentage of that. I think that it's more like maybe 30% of it needs to be bought by the dealers. Okay? And then what will happen is they will have to raise the yield, lower the price of the bonds in order for these people to buy, right? So in order for the dealers to be able to accept it all. And they have all these formulas about this is what we can do with them and sell them and everything. So they, But it works. It's an auction. It's a market thing. It's determined by market forces to say, how high of a yield / low of a price we need to get for the dealers to be able to take all of the inventory all of the debt that the government needs to issue. Okay. And when you're done, there will be basically the high yield. Okay. That's the high yield. So now everybody that was involved in the auction, that is the yield that they actually get on their treasuries. Okay. So if you bid to cover, you're getting the high yield. Okay. If even the dealers that were bidding on prices that were lower, they still get that high yield. Okay. Now, one of the things that is kind of key, and I forget what they call this, but it's not one of the metrics that you have listed, but basically you can look at what is the difference between the yield before the auction happened and the yields, the high yield from the auction. And what's the difference between those? Okay. And, like if there's a really big difference between those, then that is a concerning change that suggests that there's not really demand in the bond market for bonds at these prices and yada, yada, yada. Okay. Now, another thing that happens is you might be short the treasuries. You might be short the treasuries and you're coming to the auction to buy the treasuries to fill something that you've already sold, essentially, right? So covering a short position is a different impact on the market than buying out new positions, right? So that's what the bid to cover ratio is. So the higher the bid to cover ratio is, it's a stronger indication of actual demand for the treasuries. Okay. If the bid to cover ratio is low, that means that a lot of it was just people covering, and that demand is not actually like demand for the securities themselves. They're just closing out positions. Okay. Awards percentage of bids at high and percentage of distribution. So I think that has to do with like what percentage of the auction was taken by dealers. Okay. So you get in and you get really high numbers on those, then that means that that there was not a lot of demand for it, and the dealers really had to eat like all of it. We've seen a lot recently. Okay, and that's the main gist of what these things are. So if you work on a bond desk, you have access to information that kind of gives you an idea of what the demand for the auction is going to be. And they kind of decide what they're going to buy accordingly, and then they will come out into the treasury markets and potentially hedge themselves. Okay. So for our purposes, what we want to keep in mind is that on auction days, we will see really big icebergs. We might see price get pinned at a certain place if there's a large enough hedge out there. Generally speaking, you will see the market sell going into the auction because that's like new supply that's coming into the market. So they'll sell going in the auction, and then after the auction is over, the market will tend to buy overall. It's almost as though like we're coming along and the market is just kind of like hatching that supply. So the play is usually go long before the auction, and then after the auction, you'll get a jump, and then you can kind of look at those numbers to kind of help understand why the market maybe reacts to it the way that they do. Because some of it is going to be, there was a gap, so we need to go up to where the auction yield was. But some of it is also, the supply was, the demand was not very good on this auction, yada, yada, yada. Okay. So those are some of the things that are going on with the bond auction. Very important to understand. So if you go to the Discord, I'm too lazy to go there right now, but if you go to the Discord, there's a pinned post with an article about it that's really, really good. Maybe I should make a video about that. Truth is that I'm not an expert on the auctions, though. The snot is still kind of coming out of my the top of my head and everything, so it's kind of plugging me up still a little bit. DJT skyrocketed from 30 to 34. That's a little odd. I'm poking around here trying to figure out why the S&P 500 might be falling. The only thing that I see at the moment is ASML recoups deep sea losses. Trump media shares surge after announcing expansion into financial services, including crypto and ETFs. Oh, okay. Really does seem like something really slammed down the equity market. It's not necessarily creating flight to safety in the treasuries, though. There is a reasonable amount of activity in the treasuries this morning, and right there you're seeing a machine gun, so a robot hitting into the bid there. So it looks like there are some big players playing it here today. We need to come back and check DJT after the stock market opens. Good morning, Uzi. How are you? Gonna have to consider taking some AT&T off of the table. I don't know, like well, it's kind of a tough thing because like in the long run, AT&T probably should be worth a lot more. But in the short term, there's still some big problems with the telecoms because you know, all of the investment that they have to put into infrastructure right now and stuff. And I kind of forget what is the current driver. So yeah, and yeah, I've been holding and accumulating it for 5 years, and that's the thing is like, selling it right now it would kind of be a short-term play on a long-term position, you know. So like, were you accumulating it for 5 years just because you thought that there was going to be a short-term pop, or did you believe in the company in the long term? Now, sometimes stocks will do a jump. Like if you have a small cap and it jumps up high, a lesson that I've had to learn myself, you got to sell some of it. You just have to sell some of it because they will come in and do an offering and use that to raise more money, and then you get diluted and it sucks because you didn't make anything off of the jump. But AT&T is a huge company, right? So unless I see Warren Buffett selling some of his AT&T, I think you keep it. But I'm not giving specific advice to you. Ideally forever as long as it pays dividends. Should be a nice big juicy dividend now. Yeah. you know, during that whole thing with Goldman, because Goldman's my largest holding still, and you know, there was all that stuff going on with the consumer bank, and it was super bad, and it was all in the news, and the stock wasn't looking very good. And I'm like, is there something wrong with the company? But then it was like, no, it was just that one particular venture that wasn't really their core business anyways, right? So it would have been a bad call to have sold it when things were getting rough, because now it's like back at all-time highs, right? There's certainly a point where it goes so high that like you have to but especially with a large stock like that, one that's been undervalued or kind of lagged the overall market so much. I really think oh, come on, I can go further back than that, right? There we go. Right. So we're like only now just to like above the prices that Warren Buffett started buying tea. You know, there's still plenty of upside on this. This is basically just recovering the possibly unjustified downside down here, right? Yeah, I guess I'm not in a rush or anything. I mean it, and another thing is, look at the chart. Like, you know, this is one of the places where I think a chart can be useful that people don't consider, is like, how normal is this for AT&T? It looks like it's actually relatively normal for them. Let's go to a weekly chart instead, right? Like, look at this run up that they had in 2006. So you would think, oh, like, this is so high, it's going to have to come back and yada, yada, yada. Well, not necessarily. Because, again, we're only just to a price that 3 years ago, 3 years ago? Yeah, three or so years ago, Warren Buffett said, this company is a value play. So, like, man, you got a really good average price. If your average price is 17, good grief. That is pretty good. And that's a good, let's see here, 17. Let's just say, for the sake of argument, that it was, that you got it at 18. Then that's a good $7. $7 a share. So it's almost like a 50% gain. That's like a 50% gain. Oh, that's really good. Guess we can pull up .djt because how big of a move really is that? Prices that they were at 2 days ago. I don't know. Here's the thing, is that it doesn't seem to me that Donald Trump's followers are actually using his service. So I think that that's kind of funny. It seems to me like my initial thought on it was like, well, it's Donald Trump and people will have to get on his service to read his tweets and things like that. But then the problem was that, like, their service is not really that good. You add cryptocurrency stuff to it, like what is the killer feature there that is going to cause people to really, really want to use that? I just don't see it. So DJT hasn't done as well as many people maybe initially thought on its outset. Have you ever looked into the correlation between earnings or revenue to price momentum? No, but I would bet that the correlation is way looser than people would expect. I mean, more broadly, there's been so many different studies that are like, okay, here are the fundamental drivers, the things that we know should be driving this asset. Do the price movements correlate to changes in these things? And basically, regardless of what measure you use, it doesn't really very accurately predict price movements. So why is that? Well, because what actually moves the markets is the orders. If it's going up, it's because people are buying it. If it's going down, it's because people are selling it. The market orders, the aggressors, there's more of those on the buyer or the sell side. And the number of orders that come in is what determines how far that asset goes. So yes, earnings, revenue, things like that might be a reason for somebody to buy it, but there are so many other reasons that people buy things that it's just kind of like a drop in the bucket, you know? So really what you got to do is you have to, if you really want to make super accurate predictions, is you have to try and model all of the different flows that can be at play in that stock during the period that you're going to make a play. Now, this is where it gets interesting to me, is that like for stocks, I don't know if that kind of analysis really pays off. Like you can do all of the quantitative work and everything of modeling all of that, but the reality is that with stocks tend to go up, right? So you kind of like hedge funds that are playing in stocks, they're tending to do a lot more than just that, I think. But the commodities market, that ends up being like a really good framework to work in the commodities market, because commodities, are really more about midterm moves that happen over the course of a year or a couple of months. They aren't really very good plays for like long term. Like you by and large don't want to buy and hold a commodity. Commodities are not actually a super effective hedge against inflation like many people think, because the moves are so short-term in nature, right? So in commodities, that kind of framework works really well, whereas in stocks, you tend to do better doing things like playing with the options and being better informed about that one particular asset than other people, things like that. Now, if you really want to do all of the, I'm going to look at a stock and their balance sheet and everything about this stock to determine like what the price is going to be, then you've got to be playing on like a 5-year time horizon or higher. How antivirus software almost killed my startup. So you know what? I've been kind of consuming more like startup content and things like that. One of the things that I find really interesting is that a lot of the content that I see out there about startups is like about like getting your idea and finding the market fit and things like that. Things that I kind of feel like we've already done. So like maybe we should be calling the business that I run here like a startup, because it's a startup that's a lot further along than most other startups. Like I keep seeing these posts that are like, oh, I have begun a startup and I'm so excited I just had my first sale. And I'm like, well, that happened years ago to me. So like, I'm way further along than a lot of people. So weird to think that. Although lots of roadblocks. I was looking around yesterday. So one thing was I kind of want to level up my Rust skills a little bit more, but finding like a really good Rust project for like the level of skill that I have in Rust right now is really hard. I thought, oh, let's just do like elite code problems or something like that. But when you go and you do problems like that in Rust, it basically just ends up being a bunch of filters. It's like, okay, here's the string, get an iterator from the characters, run this filter, run this filter. You know, it's just things like that. I don't know if it really actually helps me understand the things and that matter in Rust, you know? So then I was like, let's think about, you know, like getting data in, like actually getting a data provider and like connecting to it and everything. And one side is, like one of the data providers I was looking at, they're essentially using Fix. So there's not really, I couldn't find a really good Fix library for Rust. There was just, like, what do we call it? Bindings around the quick fix C library. But I do not think I'm anywhere remotely close to skilled enough to like rewrite quick fix from the ground up in Rust. That seems like that's like a huge process. But then there's the data, one of the data services I was looking at, they have their own library for it, but it's in C. So then it's like, oh, so I would have to write my own bindings around their C library, which is also maybe a project that I'm not qualified to do, not in Rust yet. The funny thing is that the things that I was all focused on, like, you know, all of the GUI aspects of it and making the charts and things like that, kind of seems like that stuff's going to be easy. That stuff's going to be easy, and all of the difficulty is going to be in the data and handling the data from the data provider. So that's kind of a roadblock in the startup process. We're going to make our own platform. So somebody was like, they were having, you know, they were kind of perturbed at some of the things with NinjaTrader, like they couldn't use the data that they wanted and all of that sort of stuff. And I was like, well, just give me $100,000 and I'll make a platform for you. And they're like, you done something like that before? And I'm kind of like, well, I think I'm probably one of the most qualified people out there to make something like that. But, or at least out there that's like not currently working at one of, you know, on one of these platforms already. But there's definitely some gaps there, right? It is a couple steps up above what I've done before, I think. So I guess the goal now is to get there. I guess, you know, a lot of this is I'm unemployed. I'm really starting to become pessimistic about the market right now. Like, I don't think that the Federal Reserve is going to reduce interest rates. And under the current economic conditions, it seems like the hiring rate, especially in the technology industry, is going to continue to be extremely low. And if anything, it's just going to get worse because you're going to have all of these federal employees now are about to get dumped on the market as well. So I think that the going just gets tougher. And, you know, I can't guarantee that I will be able to find a job before unemployment runs out. So I need to do whatever I can to try and bring revenue in another way. Well, I have a business. We know that this business can supply a living, but, you know, it's kind of tough. it would be, if we had our own platform, that would be a great way to do it. I don't think that I can get far enough on my own platform in time, you know, because there's too much learning along the way. So I guess I have to focus on getting more cells of the indicator. But then I really don't think that, I'm very skeptical that cells of the indicator can actually replace my... I don't think that the indicators can really replace my income. Because I would have to make, like... Oh, I had calculated it. Yeah, that's right. I'd have to like sell 35 a month, something like that. 35 to 70 a month, depending on how many of them came from affiliates. None of you have sold anybody an affiliate yet, so I don't know if that's gonna do anything. Which is we kind of thought that's probably what would happen. But so even with like, if I was able to run ads and things like that, would I really be able to get above 35 sales a month? I just, is there that many people trying out NinjaTrader a month? I don't know. It seems like such an, maybe it's way more in reach than I think it is. You know what? Here's a thought. How long for a proof of concept? Oh man, I think that it would probably take me several months of full-time work to get like data working in Rust, at least. If I did it in C#, I could probably do it pretty quickly. But then I don't think that you would be providing very much value over other platforms if I was just doing it in C#. There's a new Underworld track released today. I'm excited because the last Underworld track was really good. It was really good. Oh, so I was gonna come in here. Oh, how come? Oh, that's interesting. So where is my NinjaTrader tips and tricks? There it is. So I talk about my indicators in that, but I don't necessarily get a bunch of people buying the indicators from it. But what is the viewership of it? Views. 5.4K total. That's a lot. Right? That's like a... If every single one of those people bought the indicator suite, that would be, right, hundreds of thousands of dollars. That would be millions of dollars, wouldn't it? Okay. But can I get it to you buy content, traffic source, more? I want to show it to me by month. It might not let me see it by month. Okay, wait. Come out here. Analytics. Okay, here we go. I changed tabs and it started. Dude, I'm so freaking weird about this stuff. I'm just gonna pause. I'm just gonna pause the music here. You're not gonna be able to hear it, but just the first beat of this underworld moaner has me excited, man. I'm listening to this. That is such a it's a really fat kind of acid sounding bass, a really punchy kick. I'm really liking this, man. Okay, anyways. So here it is. I wish that I could can I do a custom time frame? Okay, cuz when did this start? December 2022. Yeah, 2023 basically. There we go. Okay, so it's saying that I do about almost always more than 1,200. Always more than if let's round it to 1,000. Let's just say that we get 1,000 people coming through a month. So, and let's go for the higher end one that we want 70. That means that we would need a 7% follow through rate. But isn't it more like between 1 and 5%? Average e-commerce conversion rates are around 2.5%. Wendy. Now if I went to like the peak, 3,000, 3,300, then we're getting there. So it is possible. The main synth in this Underworld song is it sounds so classic to me. Like this is going to be remixed. This is going to be so big, the remixes of this. Especially probably in the harder dance styles. Oh, these people are saying that this song has actually been around. This track has been a secret weapon for sets for more than 25 years. This has been around that long? It's just been like is it like an unreleased track or something? Ah. How come I've never heard it before then? Appearing in 1997 on the Batman and Robin soundtrack. Oh, so I'm being triggered by something up that I've maybe actually have heard before and just don't remember. But still, with it being on their new album, maybe you will get remixes. No, I can't play it. It'll get flagged for sure. Okay. The problem you're going to run into with selling your indicators is providing examples of how they can be used to trade. I mean, paying $100 to figure it out yourself isn't going to push sales. So, yeah. And then BS asks, have you actually done a video on your indicators and their intended use case? So I do. There's a really long video. It's not very well watched. So my plan is to make videos about them individually. Some of the indicators are, you got to figure it out, but for sure. There is a problem with this one, by the way. I still don't. Maybe I have some time today to try and sort it out. Oh, that's weird. It's a bar in the middle. That's interesting. Yeah, what are the practical implications? So I'll show you something here when I'm done listening to this. When I'm done listening to this, I'll show you something. Yeah. Because some are experimental, some are like there are explicit things to do with them, right? And there's kind of a larger purpose behind the package. Right? I have built indicators on PineScript. So the issue that you get with PineScript is that you can't really do the same kind of order flow analysis that I'm doing in NinjaTrader, and those are the interesting things, right? What you can do in PineScript is basically analyze price, which is kind of like meh. Okay. Anyways, okay. So what do I want to do first? Okay. So the bigger thing with my indicators, we know that price is not really very effective. There's only so much informational content that you can pull out of price. So if we're going to be doing kind of like really short-term technical trading, we have to bring in other data. And one of the best, most quality sources of data that we can utilize is market depth, level 2 information. There's all sorts of metrics that we can do off of that. We can also sign orders, which is to say, determine whether a market order is a market buy or a market sell. And there's all sorts of analysis that we can do off of that that can really help us on a technical trade in a way that price can't. And especially when you combine that together and you know the situation and all of these other things, you can get really good trades off of it. And that's basically the way that I trade. So all of these indicators are things that I built for me, for myself, right? The problem with market depth data is that the platforms were not really built to like analyze that per se. You know, they were really built primarily to show you price charts, and then they just kind of like stuffed the order flow bit in there. And so these platforms don't manage the data very well, and in particular, they don't save the data whatsoever. So if you want to actually do a real empirical, like scientific approach to trading order flow, you can't, because the once you see it here in your platform, then the platform discards it. So what I've done is I have created ways to filter and transform that data into individual data series, and then saving those data series to disk is essentially what we've done. And then you can actually do back tests off of this. So you can say, hey, if there is a certain amount of imbalance in whether the orders are market buy and market sell, and you buy, how does that tend to work out? And whatever else you want to do on top of that. This was something that was not possible before. So my indicators allow you to do systematic trading in a way that you couldn't before. All right. Now, that means that there are a lot of tools in there that are really just about making that piece of data available to you. And you're going to take that piece of data and study it and use it in your strategy, right? But there are other indicators that are in there that I'm just actively using, and we have a pretty good idea of how to use them. And I think that the one that is kind of like the star is the inventory cost basis. So let me show you. I'm going to bring it over to this screen, actually. That's what I'm going to do. Okay. Let's look at yesterday. All right. Okay. So the whole idea is, can you estimate market maker positions? Well, that's what this indicator, the inventory cost basis, is trying to do. Okay. So it's part of my NinjaTrader indicator package you can get from speculatorstuff.com. And remember, guys, that you can download of the package comes with a free 2-week trial. So you can download and install it now, try it out for 2 weeks. And then if you want to use it after that, it's just a one-time purchase for the lifetime license. Okay. And I think I'm going to make videos about everything in the package, but I'm going to start with this one because it is by far the most sophisticated indicator in the package, and I get like so many questions about it. Okay. So I will go into some detail about how I'm calculating the values, but I want to show you what it looks like first, because I'm myself very skeptical of this idea when I first found it. And I'm still working on trying to prove what we're seeing empirically. So understand that this is like very much on like the edge of our understanding. But it's just uncanny how accurate this thing seems to be. Nothing else I've seen even comes close. You know, I've seen plenty of indicators out there where it's like there's a line, and does this line provide support or resistance or something like that? And maybe I could see how, you have enough lines on the chart and everything that you could try and say that, yeah, it's reacting to one of them. But this thing, they will hard bounce off of this line every day, and it's just absolutely nuts. Okay, so, and you can see here on the chart yesterday, a couple of good examples here. There's also these two main lines, which tend to be more, the ones that we watch more often. You tend to get bounces like that, okay? So what is it doing? Well, think about how things work for a larger market maker providing the majority of the liquidity to the markets. So the market maker will place limit orders, and when those limit orders are filled, the market maker is taking on inventory, right? Now, along the way, they're going to pick up that inventory at multiple different places, and they're also going to take profits on that inventory at multiple different places. So based on where they were filled, we can determine what the average price was, aka the cost basis that the market maker paid for their current inventory. That's what we're trying to show. So that's what these lines on the chart are. The way that it does this is it models the best and worst case scenarios based on the volume that we've actually seen in the market. So we'll do one scenario where there's a market maker that is only adding long inventory, and they're responsible for all of the fills on the bid. And then another scenario where they're only market making short. Okay. So this solid blue line is basically for that guy that's only taking on long inventory, what his average price would be. And this orange line is the how much, or sorry, it would be the cost basis for the guy that only goes short. Okay. Now, the model also attempts to model their profit-taking scenarios. So it just uses some simple heuristics. It assumes that the market maker will always take the chance to close out inventory at a profit, even if they're just making one tick from it. Okay. So based on how much profit that they've made, we get theoretical break-even points. And that's what these dotted lines are. So this dotted line is basically somebody that's market making short. They may still have been able to make profits on, some of these down moves and things like that, right? But this is the point at which there's no way that they could have a profit at all. So that's like their theoretical break-even point. Okay. Now, of course, the market is much more complicated than these naive rules, right? There's not one market maker that's responsible for all the fills. They don't necessarily take their profits in that way. What we're doing is we're just mapping out like the best and worst case scenarios. So the truth is going to be somewhere in between. It just turns out that these extreme scenarios can be incredibly useful. So how do we trade with it? Well, first thing to note is that the indicator is most useful in a market where the market maker is really in control of the market. So if there's a strong trend that day, you don't necessarily want to trade it this way. You have to use you have to use the indicator in a different way. Okay. So when there's not a strong trend or the trend is already over, in those scenarios, the market seems to have a very strong tendency to come back towards the cost basis lines in the middle and hard bounce off of those lines. So here was yesterday's action. This was, a day before a Federal Reserve meeting. So there wasn't really people looking to really make big plays in this market. So during most of our session, we just kind of rotate between these two lines. And you can see that in that, that kind of like closed range bound market, it is very, very difficult to get above those break-even lines. So if they get to the break-even line, hard bounce. So that's one particular play. Is I know that the market should be really tight. There's not really a lot of volume. Yeah, they are getting away there, but I really think that it's going to mean revert because there's just really not people trading in this market, which is what was happening today. You can take the hard reversal on those. Okay. The other one that you will see a lot, and let's go back to a previous day. You're going to get this thing where, okay, so there is a little bit of trend in the market, and then the trend is over. They will have a tendency to come back to these lines and like hard bounce off of them potentially, or at the very least, like stop for a while. Okay. So there's a part where they stop. There's a part where they kind of rode that line. So that's kind of like maybe stopping people out. I want an example of this one where, so this was actually kind of a trending day. So this is a bit, that's an example where you don't necessarily want to use it. Okay. So here's maybe a better example, right? Okay. So we have a little bit of trend, market comes back, they come back to these lines. It's just like crazy clockwork, right? Now in this one, this was like there was some sort of an economic report there, but this again is something that happens is like if a piece of news comes out that is contrary to the existing trend and creates a big spike, that spike will usually go to those lines. And I have yet to see an instance where I got a spike like that and it didn't do that. It didn't go to those lines. It's just absolutely crazy. especially the like unexpected breaking market news. I've never seen. Okay, so here's another example. I think one of the things that's a little difficult is you don't necessarily know which line, right? Because this is like the best and worst case scenario. Okay, but you can see here in this situation, blue line, strong resistance multiple times. Comes to it. So the way that I like to play it, where it I think it's the most effective as a profit taking scenario. So I will often, you know, like for instance on this move down here, right? It came down. If I'm crazy enough to take the reversal, which I think Octavius actually played this particular play, right? Maybe you bought it somewhere in here. You're going to want to take it one tick before the line, essentially. So it becomes a really, really good profit-taking mechanism. It seems to violate the lines more often than not. So I think one of the things, and maybe I should change the chart to show this, but you know, you really want to pay attention to like the most active market hours. So it's maybe, so as more time goes on, right, you're going to get more players in and all these, basically as the session goes on, they matter less. So I don't really watch it after 9:30 unless there's like a really big, you know, like market breaking news sort of thing. Okay. But there is this thing where it's like, yeah, you don't know if it's going to be this line or this line, right? So I'm saying I'm going to wait for it to come to this line and then take it short. Tends not to be a very good trade in my experience. But if you already have a long and we come up to that line, it's a really, really effective place to take profits because the chances of them bouncing off of that are extremely, extremely high for some reason. Right. So is it support and resistance? Well, I don't really like the word support and resistance, but essentially these are key points about positions for, you know, big technical players in the market. So when it gets to those points, they kind of do management. In some cases, when it comes back there, they say, okay, that's fine. We can start adding inventory here again now. And that's why, you know, they have the tendency to come down, right? There might be another situation where they say, oh, you know what? Like, it was not supposed to come back up here. I want to bail on this. That's probably what happened in this situation, was that they said, you know, this came back too quickly. I think there might have been some breaking news here. I don't know, because that is a pretty quick move, right? But in that instance, the market maker decided to puke it, right? Decided to puke it. It fell back into the hole, and then the trend continued up. Okay, so I'm not going to say support and resistance, but yeah, like areas of interest, essentially. The price has a strong tendency to react at those points. You're either going to see hard bounces, or you're going to see it hug that line, like over there. So, yes. Can you kind of track what the market maker's positioning is? It seems to me that you can. And in some narrow cases, that can give you really, really effective setups, okay? Now, you got to be careful. If we're in a trend, they're just going to ram through those lines. Okay, so the other example that I'll show you here is like the S&P 500 yesterday. So yesterday we had a pretty big recovery in the S&P 500. And so you can see they just completely blasted through those lines and ignored them. Then they came back to the theoretical break-even spot for the shorts and bounced off of it, right? This is like a really extreme example. In a more typical trend day, it will just kind of hug this line over and over again. It'll be like, it'll do this. Almost as if it's like constantly stopping everybody out as the trend continues. Okay. Hold on a second. Okay, so now another thing is that I got to warn you about, like, if you have any of these ideas that you're going to use this like the way that price action traders that claim to know the algorithm that controls the markets, okay? Like, I hope you can see that this is completely different. You have to look at the volume and figure out whether the market orders are a buy and sell in order to figure out all of this stuff out. So you just can't get to the same place with price patterns. And more broadly, I don't find that the behavior of these models match the theories of price action or support and resistance traders very well. In general, the market maker is just trying to make money from the spread based on the current conditions. They're not specifically targeting retail or anything, even if these dynamics can result in what we would call an endogenous move, which is a move that's caused purely by internal things going on inside of the market and not some outside news. Okay. Now I do want to talk about some of the properties of it, and well, let's bring back the treasury one. So properties. So there's two main properties in this. One is this cumulative and one is reset on session. And in most cases, you're going to want both of these checked. So reset on session basically says reset the currently open inventory at the beginning of the session. So if you think that like positions from multiple sessions back matter in this situation, then it might be worth it for you to turn off the reset on session, for instance. Okay. The cumulative is if I want to see what the parameters are just for this one bar, then turn off cumulative and you can see it on a bar by bar basis. And basically what happens then is the inventory gets reset every bar. Okay. There are also the caching settings. Most of my indicators have these. This is so that you can save the data and use it in backtesting, because you don't want to have to use tick replay. That really slows it down, and tick replay is not as accurate. So if you save the cache data, save and load the cache data, it is saving the data to disk, and you can do backtests on it later. If you don't want to save the data to disk, you're not going to use that. Just have save and load cache data turned off, and then you're not saving all of that to disk and using up disk space with that. Okay. You're also going to notice a ton of hidden data series. So there are a bunch of different interim steps towards calculating all of this stuff, especially calculating the theoretical break-even point, because you basically you have to know like how much inventory do they have on, what is like the total profits that they've made, and you know, how much risk they have based on the inventory that they have to calculate all this stuff. But there's a problem, which is that those numbers, that's going to be like, you know, 1,000 or 10,000. So it doesn't match the scale of your chart. So you can't graph those things on the main chart. It doesn't make sense to graph it on the main chart. And NinjaTrader doesn't allow you to have an indicator that both prints on the price chart and creates a sub data series down here. So what you could do is you could just add the indicator twice and change which ones are showing. So basically what I'm doing here is I make them transparent, and that way they don't draw or change the price access, essentially. Okay. So what I did to solve this problem is I kind of had to make a little hack, and that's what the companion is. And what the companion is if you add it to a chart that already has the cost basis on it, then what it does is it goes and finds the cost basis indicator, looks into the data series, and then pulls them out into this separate data series down here. And so that's what this is. So I find this can be really, really useful because it shows you if the market maker is adding or reducing their inventory, and which side likely has more in inventory. So in particular, when you get a situation where there's clearly the market maker is clearly holding more inventory on one side than the other, and it maybe doesn't necessarily make sense that one should be bigger than the other, that's a good situation for the market maker is going to make it easy for them to pop up. So that's kind of when shenanigans can happen. And maybe that's what was happening there. Okay. But so I find that super, super, super interesting or useful, super useful, the companion indicator. And that's a brand new thing that we just barely added. Okay. So again, you can download and use this today. Just go to my website, speculatorseth.com. If you're using NinjaTrader, you download and install the indicators, and they will work for 2 weeks. Then after that, you have to do a one-time purchase for a lifetime license. And right now it's $200 for the lifetime license, which is so incredibly dirt cheap compared to other indicator packages out there. Right. I think that, look, I can see doing the math. It's like, if I want to make a living from this, I kind of have to price it at this. And that's maybe why you get a lot of NinjaTrader packages that's like, it's $1,000, even though like the platform itself is $1,000. That seems kind of crazy to me. But my indicators are things that I really think that everybody that uses NinjaTrader can benefit from. And so I anticipate that everybody will get them. And so that's why I'm able to price them lower. And the other big benefit that you get if you buy them is you can always ask me. So if you're unsure about what it's doing or what a certain situation might mean, you can come and ask me. If there are features that you want added to me, you can come and ask me. And that's a really, really big benefit, is I'm going to be a lot more accessible and responsive than other platforms. Other platforms, you message them and maybe they get back to you, and they'd probably just ignore you. Okay. So that's how I use this one particular indicator. And I guess one other thing that I'll say is I am looking into getting into Sierra charts. It seems like I will have the time to do that in the near future, to get it into Sierra charts. I'll start with just this one. Okay. So is that a good overview of the indicator and how to use it? Because the reason why I was like, I'll show you guys is because I was planning on recording a video. I wrote up a script. These are all the things that we need to cover with it. But Uzi said you got to show how it can be used other than here's all the data. So I think this is an instance where we can show how it can be used. I do get what Midnight was saying about, like, it seems to violate the lines more than it bounces off of the lines. Part of that is this particular day. This is a day where we just weren't moving. weren't moving in this one. But it's also that you kind of have to limit it. I should add something to this chart that just highlights like the most active hours, because the further on in the session it gets, I find the less that these will matter. Just like right here. I mean, I guess you can kind of count that one. after lunch, but you know, this time period after that is basically, okay, now we have to start preparing to close out all of our positions for the close. And so then the existing positions where their existing positions don't necessarily matter as much. One side basically ends up winning, and so we will trend away from that. But it's also, you know, like this day wasn't very good trading unless you're going to trade back and forth. You know, one tactic that you can do is just trade back and forth between these lines, but it seems like the market where that one works isn't as common. And I think that some of these ones were pretty good, but there was some before that I was like really impressed with. So here you can see, here's another situation where there's like really not a lot. It's like a really tight day, and so they just kind of cluster around these two positions. Eventually it did come back to the line. I'd say that like if you get really far away from these two center points, eventually it does come back at some point. But if it were to not, that would basically suggest that the market maker got really screwed that day, right? Which can happen. It can happen. Let's go try and go further back. I need some more time to figure out more parts. Paul, just give me your machine ID. So find your NinjaTrader machine ID and message it to me on Discord, and I'll work something out for you. Okay. Oh no. Still loading. So here's an interesting example. Okay. You had news. Here's the well, what day was this? 14th? Tuesday. Oh, was that I think that one was PPI potentially. Yeah, PPI, and then it came back. Yeah. So, you have the news. Where does it go to? Right to that theoretical break-even point. We come back, and then a little bit later, after the S&P 500 opening, they made another push, and what do you know? Hard bounce. I'm telling you, you will see a hard bounce like to the tick almost every day. I can't predict if it will be the blue line or the orange line, but it will be between one of those two lines. Okay. Next day. This is still the overnight action. Okay, this was the PPI. So the PPI is, here's an example. You don't necessarily want to use these lines when it's a trend day, right? Because they're just going to go beyond the theoretical break-even point and or play across the line multiple times. Okay. So that's a good example. You have to know if it's going to be a trending market or a range-bound market. And the way that you determine that is by knowing, you know, what news is going on in the market, the situation, to determine whether there's going to be large players that will be participating or not. Okay. So here's a situation where you're down in here. Maybe you decided to buy ahead of this news. I think that this one is the jobless claims, right? So if I had a position from down here, taking my profits at the orange or blue line, whichever is closer, I guess, it would have been a pretty good profit taking strategy, wouldn't it? Next day, this is Friday. Okay, well, so here in this particular case, we had a downtrend that started. So again, when you're getting a strong trend, they're going to ignore the lines, right? But then what happened? There was a pullback, brief pullback. They go back to the orange line and hard bounce again. That one, they went what? One? Is that one? Yeah. They actually went one tick through it, which is unusual. It's usually like to the tick. In the treasuries, it's usually to the tick, which is like really crazy. You get something that's that accurate and close. Okay, so here's another example. Strong trend in the market. They're just going to ignore the lines, right? Okay, that's an interesting one because that's like way after market. Okay, but here we get a good example of a relatively tight market. They have a very difficult time getting above the dotted line. Very difficult time getting above the dotted line. Now in this case, the blue line is like way out. Oh no, that's the blue line. Oh, okay. I needed to zoom it out. Okay. So this is kind of before market, but here you get the example. Yeah, we're a little bit far away from it, but we're getting mean reversion, hard bounce. Like seriously, the first time it bounces almost to the tick every time. In this instance, they got to the buyer's cost basis. So if they were to be above, if they were to do this, that would really mean that like buyers were in charge of that market. That's kind of how I read it. Above the blue line, buyers are in charge. Below the orange line, sellers are in charge. In between, it's a dead market. Okay. So in this case, they bounced hard off of the orange line first touch. Then there was more trend, but they can't seem to get above the buyer's cost basis. The buyer is not able to completely take control. Instead, the buyer is like, oh, well, you know, it was a really bad thing of me to be taking on long inventory. Now that I'm at break even, I really better take it all off, and that's why you get these. Does that make sense? Okay, so here's a trend day. Here's another one where it's they're going to ignore the lines. Strong trend. They do eventually come back to it, though. I wouldn't trade that, but they do eventually come back to it. Right. And then this is the one that I was showing you. This is, I think, like one of the best examples, though, is like, okay, like there was a little bit of uptrend in the beginning, but they were not able to, the buyers weren't able to completely take control. Basically, when they got to the buyer's line, the buyers decided, you know, I'm going to rebalance now. Then there was a really strong selling trend. Where does the selling trend stop? Right at the line. They went through the line by 2 ticks. And then when you get the mean reversion after the trend, what does it do? Comes back to that line and it bounces off of it several times. So I wish that I could be more empirical about this one, because everything is I'm so empirical, right? And then there's this one that like we found this thing and we put it on, and like how to explain to you what's happening empirically, I don't know how to do that. But I've always seen these things where it's like, oh, you have these lines and I think that these lines matter, and it's kind of like, how do you measure that this line actually matters other than like doing a back test and testing it, for instance, right? And how many times does it go through the line or not through the line or things like that, right? And so I've always kind of thought that those kind of setups, like especially things like floor pivots, for instance, that those are maybe a little bit more of like, what would you say? Confirmation bias. Yeah, this is kind of a little bit more of a confirmation bias. But with this thing, if you know whether we're in a trending market or not, which is to say, like, there's a big buyer or seller moving the market for some reason. If we know that there isn't, and that the most influential player in the market at this time is the market maker, then it does it every time, man. It's just absolutely crazy. Right. Now, you're right that, like, okay, so if your strategy was, okay, so if your strategy is, I think that there's going to be mean reversion and you caught this trend and you're just using it as a profit taking, which is to say that you had some sort of other signal that tells you that this is a good entry, this becomes an extremely effective take profit. That's the best way to use it. If you instead were to say, this is a good entry, I'm going to go short here. Cool. Worked 1, 2, 3, and then you got screwed. Right? So, because you don't know which of the two lines. Right? Of course, then there's this other issue, which is like, if I know that like something happened here and this is just going to like trend up all day, then yeah, they're going to go through this and they're going to go up to that. Right? That's probably what you would see. Is buyers take control, maybe a bounce off of the buyer's line as they rebalance, and then they're going to go and try and push the stops. Okay, so is that a good example of, do you think that solves our problem of, we have to show examples of how they can be used to trade? Because that was kind of my intention with that. And turn it into a full video that's on there so that people can find it and everything. That's kind of like my next set of things that I'm going to try and do to get more people to buy the indicators. I think that that's really valuable, right? And then after that one, I think that I will make one about the spreads. Do your examples on NQ. So, oh man, this is, I haven't put it on there for a while, but theoretically speaking, the more thin ticked a instrument is, the less effective it's likely to be. But let's see if we can get it to work out with tick replay data and everything. I want to use the CBOT. Sorry, CME index futures 3 sessions. Okay. 1 minute. 15 days. Tick replay. Okay. Another issue is that the equity indexes have been trending so much lately that I don't know if you get a lot of situations where the market maker is in charge. And if the market maker is in charge, I'm not sure if it matters on the index. Yeah. So you basically, you asked the question that reveals the big weakness with this in terms of marketability, which is that almost everybody trading futures want to trade equity indexes. And I don't know if this method of analyzing the market is as effective on equity indexes. I have seen some behaviors similar to it in ES, but it's not like it is in ZN where it goes to it like literally to the tick every time. You know what I mean? So there's a lot more of iffiness. But then that kind of goes back to this whole thing about like these guys that think that, oh, you know, I know the algorithm that controls the market and I can use price action to determine when the market maker is going to go and screw everybody over and all of these sorts of things. No. Everything that I've seen suggests that the market maker has way, way, way less power in ES. In fact, everything that I've seen is like having a market making algorithm that market makes in ZN is probably completely different from one that I do in ES. If I'm doing it in ZN, I'm going to look at like the Japanese yen and the dollar and the other treasuries, and I'm going to look at, I'm going to keep track of my inventory and things like that. But if I'm doing ES, I think that I'm mostly either arbitraging between the index itself and the futures, or like I'm relying on arbitrage things, and I would be taking on way less inventory, and I think the things that I'm looking at are just very different. You want a thick market, yeah, which sucks because everybody's trading ES. Maybe that's the problem. Maybe the indicators, there's not as much interest in them because people are primarily interested in trading index futures. And things like the spreads are kind of like, oh, well, that's for treasuries. So if you're trading treasuries, then you absolutely want to have my indicator suite. But if you're trading equity indexes, it seems less useful. But I think that some of these are still useful on that. So you can use the spread and just plot the spread between ES and NQ. That is something that is useful. The cumulative delta thing. So being able to save the cumulative delta and backtest it, is that going to be useful in ES? Yes. Yes, it is. News warning thing is super going to be useful in ES, because how many times have you taken a trade and you forgot that there was news, or I see posts about that all the time. We kind of forget about that one that's relatively new. A lot of work went into that one. Pulled prices, you want that one on there. I think that I would need to put, well, let's just do it with the 1 there for starters and see if we can get, if it's done any, or if that's too sensitive. Yeah, too sensitive. Wow, that's actually kind of wild how many it makes. Let's try 4. A little better. Still might need to make it so. Okay, so you want me to do the same thing for this, for pulled prices? Because I think this is this is one that I made for trading equity indexes that I found to be really, really useful. Okay, so what this is looking for is, this is looking for places where essentially they skipped a price. So like you're looking at the DOM, right? And they're going to trade, 1,000 contracts to take it down at 05, and then 1,000 contracts to take it at 04 half, and down and down and down, right? Well, sometimes you can get a situation where they just completely skip a price, like that all of the orders at 05 just completely pull, and no volume ever trades at 05, and they start trading at 04 half. They skip it. And so I'm calling this a pulled price, essentially. This could happen because there was breaking news. It could happen because it was just like going too fast. Anyways, they're a little bit more common in equity indexes than they are in treasuries. You put this on the treasuries, like you almost never get a little bar. But basically that's what this is this is saying from this point, there was pulled prices there. And then it just kind of draws a little rectangle that extends out a couple of bars for you. There are two parameters, the allowed volume and the minimum gap size. So in this particular case, it's saying there can't be any volume traded at it for it to count as a gap. And it has to be, so if I was doing it on the treasuries, I would want it to be like 0 and 1. Or maybe I could say it could be like 50 volume. And that would count as a gap, right? So the higher allowed volume is, the more of these you're going to get. The higher minimum gap size is, the less of these you're going to get. Do you think that there were gaps of 8 in NQ? It's possible. 1. There was 1. Okay. But the 1 might actually be a good enough for us to use it as an example. Okay, so why do we care about these? So when you get it in just that one spot where there was like no liquidity, that means market makers did not want to hold liquidity at that price. And so this can be one of the things that results in the liquidity holes. And so what you will tend to see is that when you have a gap like that, price has a tendency to kind of rotate and come back to it. So you can kind of see here in this situation, there was a trend down, but then after that, and you have the gap, and then after that, all of a sudden price gets kind of flaky and starts going sideways and reverts back up. Do you think if we go further back, it'll show us some other cases? It should have shown us, like on some of those big ones. I would have thought that you'd have them. Okay, so here's some examples. Right. Okay. Big trend down, and then what happens? Market makers stop holding liquidity. It starts going sideways. I tell you what, man, this one particular thing. So this is an order. Just note, this is order flow. It's using order flow to determine this. You can't determine this from price. Okay. It's just, I find this particular one so funny because I so much would, that's like when it gets exciting. That's when I would get in, and I would always get in and then it'd go nowhere. And I'm like, what's going on? Okay. So here's another example. Something that you see happen a lot is you'll get this pulled prices thing happen, but like there is a real trend, so it moves away from it. But what do you know? It comes right back to it later. By the way, after about 45 minutes, I would say that it doesn't really matter. But in this case, that was only 20 minutes, right? So that probably holds, and then I'm going to bet you that's a good, let's see here. So that's 1935. Oh, okay. So in this case, 40 minutes afterwards, then they decided, okay, we can move up a little bit higher. Now there's one that's kind of a lone thing all by itself, but I don't actually know what caused that big down thing. So maybe if this big down thing didn't matter, maybe they would have come back down to this and, done it there as well. Okay, here's an example. You're kind of already getting price like reverting back on itself here, but there's a pulled price and it just kind of continues to go sideways there. Right. Okay, now these ones, this one is different. So you do get here, here, and here some places where it's like, it's just, it does it again. Likes to revert back on itself and come back to that spot. But there's also all of this mess. Right. But in this situation, I think it's because of the time. This is like after the market closed. So that's probably caused by some sort of significant earnings release. Here's an example. We're down. Big jump up. There's a pulled price. And what do you know? We go sideways. Right? Okay, now this is an interesting one. And this is actually during the most active market hours where the price is getting pulled down here resulted in a reversal. Now that might just be, you know, because this is only 8 ticks. So, you know, maybe our settings aren't going to pick them up well enough all the time. Here you get one that's like, there's a big trend up, and then what do you know? All of a sudden it starts going back and forth in this one spot for no apparent reason. When you start getting, like, if you have a position and it goes up big time, and then you start seeing these things formed, good profit taking location. Good profit taking location. Or if you're looking for mean reversion trades, you know, you might want to think about mean reversion trades. Okay, here's a situation where it didn't work. So I don't know if this one is back testable, but can I make it back testable? I think I can. I think I can make it back testable. This one, well, you could back test, but you would have to use tick replay, right? I have to go back and make it back testable and see if I can just... every time one of these happens, take a trade and hold it for 30 minutes and see what happens. And what you should see is that by and large, the volatility after that point will tend to be less than it is on average based on what the volatility was at the time. Like right here, it's like, okay, we just had a lot of volatility. So if I was looking at like ATR on the 1 minute chart, I should expect ATR to be relatively high, but then the range that it goes in this time is much lower than that, right? So it helps you see a point where it's either going to revert or is just, you know, it's going to stay there. By the way, on this one, did they ever... No. Sometimes it also does this thing where, again, it goes away from it and it comes back to it. Like, kind of like this. Right? So they were forming that hole here. So then for some reason there was a move down and then it comes back to it. You see that pattern a lot. There's a good one. It's like relatively good trend, and then all of a sudden the market maker pulls its liquidity, and then what do you know? It goes sideways. I think that they're so funny because every time that you're looking at it, it's like, oh man, this is this great trend. Like I would love to get in there, right? Oh, it was this one. This one is 0126. That was... Oh, this is the gap. This is the weekend gap. I gotcha. Okay. But let's just ignore that part right here. You're like, oh, this is such an amazing trend. Wouldn't, you know, if you were just looking at... Let me really zoom it in. Okay. Oh, no. Was it this? No, this is something else. That one's probably a bad example, in fact. Because that's like way serious volatility, right? No. 26. Oh, here we go. Okay. So you're watching this chart. Don't you want to go short? Don't you want to go short? Okay, but then you get this one and a little pullback. Okay, no big deal. Don't you, right there, like, okay, pull back. Doesn't that still look like a, hey, the trend is gonna continue. Let's go short. Oh, so nope, it just goes sideways now. Like, I just think it's so amusing because I would always, for the longest time, man, before I developed this thing and understood this concept and found this, because it is a real proven empirical behavior of the order flow. This the whole liquidity whole thing, right? Like this is the square root law. These are the things that lead to the square root law, essentially. I would always, okay, we got to pull back. I'm gonna go short right here. I'm gonna go short right here. And then, like 5 minutes, 30 minutes go by, and I'm like, what the hell? Why isn't the trend continuing? Right? Be frustrated every time. And it's kind of fun to laugh at old Seth. So I think that the problem with this one from a marketability standpoint is that this kind of ends up being hey, you might want to think twice about that spot for a trade, right? Like if you don't already have a trade on, this is maybe not the best place to initiate a trade, right? So it doesn't give you entries, and I think that people want entries, So that's probably the problem with that one. Oh, there's an even better example, man. Hey, doesn't that seem like you want to go short there? No, because you got the line is going to go sideways. Bada boom. So that's one that I could share with you on it. But we reasoned that we created this chart was to look at the inventory cost basis with it, wasn't it? Yeah, that was just a little sidetrack that we were doing. Okay. So like one of the things that, that's actually, yeah, one of the things that you kind of get on, and you know what else? Is it actually doing it correct here? Oh, I think it is. Yeah, so this is the first problem is that the take profit bits get like really wild for some reason. So it's almost like the market makers like don't like to hold as much inventory or something. Actually, let's come back here and now let's add the companion. Okay, wow. It's kind of interesting, that spot right there. I wonder if there's anything to that, but digress. You get these spots where the dotted lines just like move back and forth wildly. And I don't really understand why that happens, to be honest with you. And it only happens on these really thin ticked instruments. So it's like something like that. I thought that maybe it would show their inventory. Actually, we can add the other ones. So in the companion, I can just come into this and I can say, maybe turn these ones on, profits long and profits short. And turn these ones off. Transparent. Which of the sub data series is going wild? Nope, it's not that one. Interesting. So is it their risk? Oh, is it still loading here? Yeah, it is the risk bit. So for some reason on these thin ticked instruments, you get these situations where the amount of risk that the market maker is holding at that time, like you get these huge spikes up in it. And that brings their break even point like back into where their average is. So that's kind of a little bit messy. But you do still see some of the behaviors, right? It's just a little bit more messy. It's a little bit less exact. It's hard for them to stay above the dotted line. They have a tendency to come back to the line and bounce. Here you go. Here's the two lines. The market is just going between the two lines, right? Neither side is in control. That's actually a really great example. Not as useful. That's interesting. That's really interesting. That's kind of the behavior that you'd want to see, generally speaking, though. They're going to go back and forth between the two positions. And this is where you can kind of treat the two lines as support and resistance to some extent. This is like if it's below this, then the shorts have an incentive to take profits, and if it's above this, the longs have an incentive to take profits, and so it just goes back and forth. And then there's the other things like volatility projected range. Do I have one that's... Oh, you know what? I thought I was going to add that, and I totally forgot about it. This is make one that, has or I'll just call it ATR projected range. There we go. Should do an ATR projected range. That would be cool. Why don't I have that on my list here? Oh, I did export the indicators version 3322. I put it in the paid Discord. I don't know if, you know, I guess I could probably put it on the website now. Then I already added that other thing in there. But what was No, I think that was it. That was all I needed. I don't know. I guess the issue is still I'm a little bit skeptical about how effective order flow can really be for trading equity indexes. I guess I'm a little bit skeptical about how effective you can really trade equity indexes overall, because your ability to be the informed trader in that situation is just significantly less. And, you know, the things that you're going to want to be looking at is kind of more the arbitrage opportunities between the index itself, which basically would mean like watch every stock, watch all 500 stocks and constantly calculate what the index should be based on those, and then possibly arbitrage, right? Or using gamma, right, which is a form of analysis that I do not have the data to do. Do you know when the new JS, you mean Jigsaw? The new version? I don't know. They've been real quiet over there lately. Like, even their chat rooms have been pretty quiet lately. I just got a survey email from NinjaTrader asking if I'm interested in trading single stock. What? This is somebody talking about making a CFD for individual stocks. That's what that sounds like to me. I don't. Can that even be legal? Like, yeah. Yeah, especially it coming from the platform / broker, because I don't think that you would ever see like the CME make those, right? That's that's a little concerning to me. Yeah, especially since there's like all of these things like you can trade partial shares and things like that. Trade Robinhood with no commissions. Like, why would you do a future? I don't know if that makes well. If they send me that survey, I will say no. I am absolutely not interested. I think it's a terrible idea. I've never found any empirical research specifically related to index futures. I've seen a lot of, which is kind of one of the things that really irks me, is like I've seen a lot of studies where they're like, well, we use the index futures to prove this, but they're proving something that we should see in like all limit order book markets. But like something that's like specific to index futures that we can potentially make a profit from is more interesting. I don't think I've ever seen that. High frequency lead lag relationships in the Chinese stock index futures. Okay, so they're basically saying, look at individual stocks and the index, and you find some situations where one or the other will lead, and you can trade off of that. A GCN LSTM approach for E-mini and VX futures forecasting. So the problem with this one is that those models are going to be like a modeling on a day basis and not necessarily good for scalps. Minute by minute financial markets reaction to the 2020 election. So there's a cross-sectional strategy, so that's a momentum thing. Okay, so here's one where they're using they're using order book data and machine learning to make short-term high-frequency predictions, and they happen to use the CSI 300. So that's one place where it's like, okay, so you add all of these order flow indicators to your chart, and then you start doing the machine learning part. But this is where we would really like to have our own platform, because then we could just plug Python in and do those things super hyper easy. Whereas with the way that we've got it in NinjaTrader, I have to make like a connector and pass data between the two of them and all this nonsense. Profitability of simple stationary technical trading rules. Bayesian modeling and forecasting of 24-hour high-frequency volatility. See, there's lots of things about trying to... Because the issue that you get with... another thing with the index futures is that, like, so much of the research is just trying to predict volatility, because the way that these guys in the industry really make the money is by selling the futures, or sorry, by selling the options. They're selling options, and that's how they make. So if they can make better predictions of what the volatility is going to be, then they can make more money. And that's why you get so many of these studies about that. Here's something about the bid-ask spread. Technical trading rules have been used by practitioners in financial markets for a long term. The profitability remains controversial, and few consider the stationarity of technical indicators used in trading rules. We convert MA, I think that means moving average. What would KDJ be? I don't know what that would be. Or Bollinger Bands into stationary processes, and investigate the profitability of these trading rules by using 3 high frequency data, so 15-second, 30-second, and 60-second, of CSI 300 stock index futures from January 4th, 2012 to December 31st, 2016. So 4 years, that's not bad. Several performance and risk measures are adopted to assess the practical value of all trading rules directly, while ADF test is used to verify the stationarity, and SPA test to check whether the trading rules perform well due to intrinsic superiority or pure luck. Whoa, wait. What is a SPA test? It wants to send me to something about hot tubs. Saddle point approximation. A test for superior predictive ability. We propose a new test for superior predictive ability. The new test compares favorably to the reality check RC for data snooping because it is more powerful and less sensitive to poor and irrelevant alternatives. The improvements are achieved by 2 modifications of RC. We use studentized test statistic that reduces the influence of erratic forecasts and invoke a sample-dependent null distribution. The advantages of the new tests are confirmed by Monte Carlo experiments and empirical exercise in which we compare a large number of regression-based forecasts of annual U.S. inflation to a simple random walk forecast. The random walk forecast is found to be inferior to the regression-based forecasts, and interestingly, the best sample performance is achieved by models that have a Phillips curve structure. That's interesting. Superior predictive ability test, is that what it stands for? I think that the ADF is like Adley Dickey Fuller, something like that. Augmented Dickey Fuller, that's right. Augmented Dickey Fuller test. To test the null hypothesis that a root unit is present in a time series sample. So this is, I actually have one of those on there. Oh, so could you say take the inventory cost basis and do the augmented Dickey Fuller test against the price series and to see if that's okay? Let's try that. I think I can do that. I'm gonna go back and I'm gonna do it on ZN because, you know, like, just is so much more effective. And we'll do 30 days tick replay. Yes. Okay. What did I call it? Did I call it Dickey Fuller? No. So many indicators in here that I'm just kind of like, what is it? Maybe you don't have it on this machine. Oh, here it is, CADF. Symbol 2. Okay. So in order for me to do it, I probably need to make like a second indicator that takes it so that I can pass the specific data series that I want into symbol 2. I was trading Forex and I was not profitable, and now I'm trading futures with the DOM. Can you help me? Because, well, so the first question is, like, just put away the DOM. What is your trading plan for the day? Like, what are you looking to see this morning in the market? I don't know what you're trading. Probably best if you're trading treasuries, but because then I know exactly what the answer should be from you. But yeah, let's see. Is there an indicator out there built into NinjaTrader where it has two data series and you can pick between? Like, I have one where, you know, like I add like in the spreads, right? But I don't have one where it's like, if I want one part of the spread to be the simple moving average of this thing, yada yada yada, blah blah blah, right? Like, I don't think I have that one. I have one, but it would have to be one where it has two, where it takes two data series as input, because almost all of them you can have one data series as input. Otherwise, I just kind of have to like hard code it. Okay, well, let's just hard code. I try to catch absorption after market relation back to trend. Okay, that's what I thought we were going to say. Okay, so here's how I would approach this. Okay, just completely forget everything else that you know for a second. There is a Federal Reserve meeting today at 2 o'clock Eastern time. 2 o'clock Eastern time, they're going to announce the results of, if there's going to be an interest rate increase or not, which there should be no change. And then 30 minutes after that, they're going to have a meeting. And people are going to listen to Jerome Powell speak, and then they're going to decide whether they're going to buy or sell based on whether he's speaking. Until that point, unless people seem to think they know something that's really effective at predicting what the Federal Reserve is going to say today, unless they're making some sort of a bet like that, there's no reason for them to come in and make big trades, right? Like if I'm somebody, I need to buy a bunch of something, and like I wanted to have all that stuff done already. Like big players, they're not going to be here in the market doing a whole lot. So what you have is a market that is going to be relatively quiet and sideways. So what should my game plan for today be? Either I think that I can make money from the really quiet market making action, which in most cases you can't, or I'm just not going to trade today because there's a Federal Reserve meeting, right? So you really, the first thing that you really need to do if you're going to be trading is you've got to know what's going on in the market. Follow the news, look at what the economic reports that are coming out, follow the discussion about, what's going on in the economy, et cetera, to have some idea about what kind of plays the big players are going to make that day. Then I can use my reading of order flow and everything else that I know to interpret the data that I'm getting to see if my expectations about what's going on are actually correct and whether there's actually a trade to make. But if you're just trying to know literally nothing about what's going on today, in this particular case, not noting that it's a Federal Reserve Day, then you're probably not going to get very far. Get what I mean? So that's where I would start. Like if I try to catch absorption after market maker relation back to the trend, you're basically always taking absorption against the trend. So in a trending market, you just can get slaughtered. But if I have a move and I really don't think that move should result in a trending market that day because I know why it's moving and I think it's a dumb reason, and I not that it's a dumb reason, but I just know that it's going to be a short-lived thing, and then I see market makers, then it's a good trade, right? But it's all contextually based. Yeah, anybody that's like watching my screen right now is probably like, this is not so. Augmented Dickey Fuller test is crazy complicated. Right? Oh, where is on this the on bar update? There we go. That's it right there. You need closes. You just need close. And then you need underscore inventory dot. Oh, come on. Price series. An I series, a price series. Wait. Yeah. Oh, that's curious. What is the function? Okay, so the CADF indicator is an augmented Dickey-Fuller test. And the purpose of the base indicator is to tell if price series 1 is a component of price series 2. So basically it's a test for co-integration. If the two are co-integrated. So like if the two are co-integrated, then like you have this one, like let's say that this one is a flat line and then the other one moves around it. And we do a CADF test and it should give us a statistic out that says, yes, it's highly likely that this data series is a component of this data series because this flat line is preventing it from getting too far away from that. So what I'm doing is I've got my inventory cost basis and I'm asking, is price co-integrated with the inventory cost basis? But it wants to use a price series, and so I think it's super, super interesting that closes is a price series. So I think that I can change this, but it's okay. But for some reason, the IntelliSense is not picking up the inventory. See, when I do dot, it doesn't like it. They should really have the on bar update at the top. That's dumb. Okay. Oh, okay. Oh, that was a dumb mistake. That was a dumb mistake. I put my instance variable in the namespace and not under the actual variables region. That's probably why the IntelliSense wasn't working. Okay, cool. So now I should be able to come back down to here and ha. Okay. Will it accept that though? I don't think it will. It'll say, yeah. Price series. Not convert from price series to, from Ninja script series to a price series. Oh. Okay. So it should be able to use you know, in some of these, like, hold on, look at some private code here. I think it should just be this. Not convert from. Oh wait, is this an I series? I series. Oh, okay. You can fix that. I'm back here. Then this should be closes. Yeah. We should both work though, I think. Ta-da! Okay. I forget how to interpret this number. Coming back into here, I think it maybe says stuff. The tests on 2 instruments over a period. We'll skip over any unsynchronized bars while asking. Bot. Crit 1, crit 5, crit 10. Somewhere in here it tells me. Where did I find this? I did not make CADF, by the way. I think I got it off of Futures.io. Because basically the issue with this indicator is that it uses a library in C# called alglib, and basically alglib uses like a different version of NinjaTrader. So like they've copied over all of the functions into this, and all. So it's kind of this thing where I can't really give it to you. It's harder but you can find it on the NinjaTrader forum, and yeah. Where did this person post it? Oh. Let's see if I can find it. Here it is. Okay. The plots are the 1%, 5%, and 10%. Okay. So it's saying, oh wow, okay, interesting. Very interesting. Yes, and that's exactly what I would expect too. Oh my god, is this actually proof? Is this actually the proof that I've been trying to figure out? Takes it a bit to calculate, doesn't it? Yeah, it is. So when we get into a really quiet market, it's saying there's a very high probability that the cost basis is a component of this series. But then when it starts to trend, it says, no, it's not. Which is exactly what I'm saying, right? Like when it's trending, you don't want to use it. Oh, I missed your answer on CADF. What did you ask? Okay. The function of the CADF, it is an augmented Dickey-Fuller test. This is a statistical test that you can use to determine if one data series is a component of the other data series. So you might have something like so a really good example is I have a currency that's pegged to another currency, right? So the value of this currency, so like here's the dollar, right? And then the value of their currency is going to go around the dollar essentially, right? And so if I am doing some sort of like arbitrage strategy, then what I want to do is I want to say when this data series gets too far away from this data series, I want to take the trade on the expectation that eventually they will come back together. So I'll buy this one and sell this one and yada, 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 right? This is what it's created for. So, you know, often we do, are these two correlated? When this one goes up, does this one go up? But there's kind of some issues with that. So one way that people have figured out how to do that is they look if they are co-integrated. They are co-integrated. And augmented Dickey-Fuller test is one way that you can test for if two data series are co-integrated. So essentially, what the way that you would like create a strategy out of this is to say when the CADF value is really low, below this line right here, this 3.92, and we are really far away from where this line says that we should be, then take the trade on the expectation that they're going to come back in line. It says lower values. So a value, it's looking for a value of -3. Or is it that you only want to do it when it's above it like that because it's negative? I'm not sure. It kind of seems like it's when it's negative makes more sense, but let's look at a different day. Okay, yeah, no. When it's trending, it'll be above it. Yeah. So we want situations where it's clearly below. Like here. Oh, that's interesting. So now I'm thinking about what kind of a automated system would I write with this? And I think that what you would do is you would say, like, when the market maker is in charge, if I know which way I think it's going to go, get it when it's too far below. So like I would maybe, if I knew, let's just say that I knew what the news was going to be. So I know I'm going to sell it. When's the best time to sell it? Wait for the low statistic right here. You'd sell it right here. Maybe. We'd have to backtest that. But okay, so you can see here, though, that it's like very much... yeah. Now I'm only doing it on the buy line. Because there's this other issue, which is like, which line matters? We might be able to improve the indicator to pick one of those two lines at any given time. But we could also change it to say, go for this stop, right? And maybe in this situation right here, we would see really low p-values. We would see it below that 3.92 or whatever. See, when it comes back to the line, the test says a very high probability that they're correlated. Now, I have it, so let's see here. Period is 250. Oh, okay. I think that the period should be a lot smaller than that. I think the period should be like 30 bar period. Interesting. Oh, and I'm using the buy line, not the sell line also, by the way. I may be misapplying the statistics. I don't think I completely understand the statistics behind this stuff. It's been a while. What if I set it to a really high level, like 500? Because what I'd really like to see is periods where it's below and then periods where it's, you know, like that. Say, this is when you trade it and this is when you don't. Probably me increasing the period probably makes it take even longer. Oh, yeah, there you go. There it is again. So maybe I can go back and redo my back tests and say when the inventory cost basis, when price is above the break-even line and the CADF is really spiking down, showing that there is a real correlation. There's a real, what do we call it? High chance that it's being affected by the thing. You take the mean reversion trade, because there's two instances where it very clearly picked it out. Okay, so this one probably wouldn't count because it wasn't above the line. Here's one. Well, it's not above the line, but it's still right? When it spikes like that, it reverses. Okay, now here's a more interesting one. What did it do? It spiked up first and then later it went down. Wonder if that was them trying to check people out. So they can still play games. So here's the one where it's not, well, it's above the blue line. So you take it short. What do you mean by AMT? There's like too many things that could stand for. Oh, it's 9:30. I didn't realize. We're like way. So is this pointing towards instances where some wild price action happened? And essentially, yes. Is it essentially saying that like the market makers took on too much inventory through that area, and they are now like if we were going up, if it went up, they took on too much inventory on that area, so now they aren't holding as many bids, so that it's more likely that the market will drop back down and they can rebalance their inventory. If not, straight up make money on all of the short inventory that they picked up. And this stuff is spiking when that is clearly happening, when it's that they're getting pulled back into this. Now, there's still this problem that there's these two series. But I think that these two series tend to move along with each other pretty good. And the whole augmented Dickey-Fuller test, part of what it does is it takes out the difference in prices between these two things. So it shouldn't matter which one of these I use, I don't think. So 10 year, I wouldn't be able to run it on 10 years because the inventory cost basis requires signed order flow to work. It has to know whether market orders are buy or sell and what price they were traded at in order to determine which prices the market maker theoretically picked things up at. I don't know if this is proving things for me or not, but it is kind of saying, like, basically what it's saying right now is market maker doesn't matter because there's some sort of a trend going on. It's probably because of that, right? But then over here, pretty high probability that the market maker's positioning does matter. And what we should see is regimes where it switches between those. And when it gets into the regime where it's pretty likely that the market maker does matter, that's when we trade it. That's when we say it's going to come back to the line. Wild stuff, isn't it? But I'm probably also like, it's probably more interesting to you guys because I'm so shocked by the result, but and that's just because I've spent so much time trying to figure out like how do you determine that this line matters? You know? More testing required, yeah.
I mean, part of the thing is that, so another thing is that if this was always down below, then it would probably be that we had made a flaw. Like, I bet you that if you did something like, you had a 10 period moving average on here, okay, then this CADF thing would probably always be showing a really high value, because the reality is it's the opposite. The moving average is created essentially from the price, and so of course the price is a component of the moving average, right? But the fact that you go through periods where it's really strongly does and really strongly doesn't suggests that there is something to it. And the periods where we're seeing that it really strongly does and really strongly doesn't are all ones where we would expect it to be doing that. Is like right here. Yeah, it's going to mean revert. So, and I would even say that in some instances it's almost predictive that, like, you know, if I say as soon as it gets to this point, like right here, and I buy it on the mean reversion play, yep. So it seems like it actually can give you extremely effective predictions. It's really crazy. I'm kind of wigging out. Well, I should add it to the chart tomorrow, and if we get one of those situations, try it and see if we can if it works out. Like when we add discretion to it, it still works well. I have a question. If you mean that order flow influences prices, but prices are statistically efficient, shouldn't it be possible to predict the order flow directly via the price? Where is the flaw? Yeah, so I think that you that would be kind of like, okay, so let's say that you have two variables, right? You have X and you have Y. And we usually call this one the what? The independent. I should be like the guy in Ferris Bueller. Anybody? What's this one? Y is the anybody? Dependent. Variable. Okay. So, what I'm saying is that the independent variable here is the order flow. And the dependent variable is price. This is true. You can prove this, actually. Because if you put the exact same set of orders into the market, you will get the exact same price out. Okay? The price is a direct result of the order flow that's been put in. Okay? So, can you do the opposite, where you say, I know what the price is, and based on that, I can predict the order flow that's going to come out? Or more broadly, I could say, okay, I've had order flow has come in, I've got a certain price, and now can I go back around and get the next set of order flow based on that price or something like that? No, not necessarily. And why is that? Well, you know, some order flow, if we were going to draw the market, some order flow, some of the things that happen, you get a price out, right? Let's try this better. We have a box called the market. Okay. Out comes the price. Okay.
orders. Out comes the price. Okay. One of the inputs into these orders is the current price. It's one of the things that they consider, right? But there's also a trillion other things that come in. And in kind of the research that we've done, we kind of find that at least in the current market, these things matter more. These things matter more. That, like, because the biggest players are so price agnostic, that the things that will cause the biggest players to come in and submit orders to the markets matters way more than what the past price was. So if all you have is the price and you want to try and predict the next set of orders, it's not going to be very effective. But more broadly, it just kind of explains why price alone on very short time frames is not very useful. Now, what happens is this. This is where kind of all of this, why we figured all of this stuff out. Because I think that the researchers are kind of giving you a hint about, like, where, like the stuff that Renaissance Capital does that we don't know what it is. It's like, here's that next step. Well, we're not going to tell you what that next step is. Not until, like, the edge is completely worn out. And then someday, before we die, I think we will know these answers. Okay, but what happens is you trade a ton of something. If I trade X, it's going to move yay much. That's how much so X orders results in Y amount of movement. If I do 2X, then should that result in 2Y movement? No. No, it does not. 2X actually results in 1.414 blah, 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 blah amount of Y. Okay. So it follows a square root law. And if that was graphed, it would look like this. So if I need to buy a ton of something, there is a limit to how far it can go. And that's kind of an advantage to you. But then there's this point at which the impact just like it goes crazy because the market becomes unhinged. You don't want to do that because you want to minimize your impact on the market. So what do? You trade it in waves. You do it like this. You get to where your impact is slowing down. So you slow off and you get this long mean reversion period, and then you do another wave a little bit later, 45 minutes later, and then you do that, right? And you buy that, okay? And you can do that like 3, 4, or 5 times in a day, okay? There is a limit, essentially, to how far the asset can move. So if we have a market and it's going like, let's say that the market is NVIDIA. NVIDIA is going along, and then all of a sudden we find out that they're not going to sell as many NVIDIA GPUs. I don't know if that news that we got yesterday necessarily says that, but some people are saying that that's what's going to be the result of it, right? And we can perfectly calculate what NVIDIA should be worth now. And we say, and this is like a daily chart, we say that NVIDIA should be worth like this now. Okay? Well, assuming that you don't get an unhinged market, it can only move so far in a day because of that stuff. You see? Because the square root law, there's a ceiling on your impact. So it can't do it in one day. It takes a long time for it to happen. And there's these guys, they want to buy or sell a ton of something. Maybe the situation is they need to buy 1 million of shares or something. Somebody wants to sell off 20% stake in it or something like that, right? You can't do that all in one day. And so what will happen is you'll come in and you'll sell a little bit of it every day. And that results in what? Trends. That results in trends. So do we know? We might not necessarily know if a market is trending or not. But what we do know is that if we get in at the start of a trend, we make so much money over the course of trend that it essentially makes up for every time that a trend might be starting and it doesn't. On a daily basis, right? Doesn't work on an intraday basis because it can only move so far in one day, right? Because of the square root law. But more broadly speaking, you get trends. And so the reason that all of this research happened was because these guys came in and they found statistical ways to create a momentum portfolio. And then they were like, well, this makes no sense. The market is perfectly efficient. Why does a momentum portfolio work? So then they went into the market microstructure. They found the square root law, all of these other things, and they realize how the square root law relates to why the market will see trends. You see? And so that's why you can come in and say, you know, if there's a certain amount of trend in the thing, then get on board and then just hold on to it. But it only works on a daily basis. Okay? So that's why I was answering it with your question about, like, you know, can you predict the order flow directly by the price and everything? So my way of trading is, if we go back to this picture and we get a price out, well, you know, part of it is the previous price, part of it is these guys. If I can come in and I can say, this is momentum, this is fundamental traders, this is dealers, etc., etc., etc. If I can model these individual players and predict how these individual players are going to react to the market, and then combine them all together, each one of these is an order flow. I combine all of the order flows together, and then if I find that when you combine all of the order flows together, that there is an imbalance between buyers and sellers, then I take a trade. And that's how I trade. That involves, now, how do these guys, what is the input to these guys, right? Well, for momentum, it is just price. For momentum traders, it is just price, okay? But these fundamental guys, they're pulling in all of this other information from here, right? Dealers, maybe they're pulling other pieces of information and maybe some shared pieces of information, right? So this is why, like, you have to know what's going on in the market. Like, theoretically, each one of these lines could be a data series that could be a computer, right? But, like, we just don't have the data, the technology, everything set up to a place where I can really turn those things all into a data series. So what do I have to do? I have to go and read CNBC, read Zero Hedge, read analyst reports from JP Morgan and Goldman Sachs, and follow all of the individual, like, every piece of financial information that I possibly can, and then evaluate it for whether it will affect the behavior of these different players, right? And what happens is retail traders, they talked to a momentum trader that only does this one thing and said, oh, well, this one thing totally works. Well, it did in the 80s. It's more complicated than that. Doesn't work on a day trading basis. But everybody tried to use this and tried to day trade and ignored the rest of this picture. And that's why the retail traders have such a hard time. Of course, if you have that whole picture, it's still really hard to trade because there is still so much randomness in it. But at least you're playing the game at that point. At least you stand a chance. That's what I'm saying. Anyways, so that's the way it works. Yeah. Oh man, that Tiki, I'm still like wigging out about the Tiki Fuller thing. But I've gotten like way over time today. I will be back for the Federal Reserve meeting. So I'll see you guys in 2 hours. In the meantime, stay excellent.